Guys, we need to talk about the biggest financial gamble in the history of Hollywood. By now, most of you guys have heard the news that Paramount and Warner Bros. Discovery are officially on their way to tie the knot in marital bliss. Now, on the surface, it looks like a titan is being born, right? Like we got DC, Game of Thrones, Mission Impossible, Star Trek, all under one roof. But there's a catch. You see, there's a monster hiding under the bed of this deal. A monster that doesn't care about box office numbers or streaming subscribers, and that monster is called $79 billion. That is the pro forma net debt that the combined Paramount Warner Bros. Entity is expected to carry. Now, to put that into perspective, that is more than the entire market cap of most major media companies. So today, we're going to take a look at why this debt isn't just a number on a spreadsheet. It's a ticking time bomb that costs Paramount Pictures millions of dollars every single time the sun rises. The entire industry knows it. I'm not the only one looking at this with a raised eyebrow. The financial world is as well. Frankly, they're terrified. When the deal was finalized, Fitch Ratings didn't celebrate. They downgraded Paramount's credit to a junk bond status. They noted that Paramount's leverage and free cash flow may remain in negative rating sensitivities much longer than anybody hoped. Being downgraded to a junk bond status carries with it several negative implications. Number one, borrowing money becomes more expensive. A junk rating means lenders see the company as riskier, so they demand higher interest rates to lend money. Number two, some institutional investors are forced to sell. Many big investors, pension funds, insurance companies, certain mutual funds, are only allowed to hold investment-grade bonds. When a company becomes downgraded to junk, those funds must sell the bonds. Number three, it signals financial stress to the market. Being downgraded to junk tells the rest of the market that Paramount has a higher risk of defaulting on any loans relative to investment-grade firms. In other words, it's a warning not to lend them money or get in business with them because they are financially unstable. Now, as a matter of fact, Robert Fishman from the equity research firm MoffettNathanson put it bluntly when he said, investors had been growing skeptical of the risk of overpaying for a business that has failed to deliver a clear economic return to its past several owners. On top of that, Richard Greenfield from Lightshed Partners put it this way, over-leveraging to buy Warner Bros. Discovery is the wrong strategy. I hope Paramount doesn't do something quote-unquote price stupid. The consensus? Paramount is walking into a lake with a backpack full of lead bars. But now let's get into the really scary part, the part that should keep the Paramount board of directors up at night. How do you service $79 billion of debt? You pay interest. And because of their junk credit status, they aren't getting the friends and family rate anymore. We are looking at an effective interest rate of roughly 5.7% according to analysts. Now that sounds small, right? I mean, the average American has to pay 20 to 25% in interest on their credit card debts, so 5.7% sounds easy, right? Well, let's do the math. 5.7% of $79 billion is an annual interest payment of $4.5 billion just to keep the debt from getting higher, just to keep the collectors from coming to your door. And when you break it all down, it actually gets even more staggering. Think about this. Every month, Paramount is going to have to find an additional $375 million just in interest on their debt. Every week, that's $86.5 million. Every single day, Paramount is losing $12.3 million to interest. And if you want to bring it right down to the hour, every hour costs them $500,000. Or heck, if you even want to go smaller, how about this? Every single second that ticks off the clock, every second cost them about $142. The time that it took me just to say that sentence ran up the debt by another $2,000. Now think about that. Every 24 hours, the cost of an entire mid-budget indie movie just vanishes into the pockets of the banks. Every 12 to 13 days, they would have had the money to pay for a brand new Superman movie with the money that they're now paying in interest alone. So, okay, at the end of the day, it's Paramount and it's Warner Brothers. They have a lot of smart people there. So what is their survival plan? Well, the plan is this. Paramount and Skydance have promised $6 billion in cost synergies. Now, in Hollywood speak, that means layoffs, selling off non-core assets, and massive budget cuts. They're betting that by combining their libraries, they can finally make streaming profitable enough to outrun this huge interest rate. But can they cut enough? Can they slash enough? Can they downsize enough to beat $79 billion in debt? Here's the reality. They are going to be running a race where every day they start $12 million behind. Is the Paramount Mountain going to be strong enough to hold up $79 billion in debt? Can they strategize their way around this into profitability? Or is the whole thing about to come sliding down? You guys tell me. Thanks so much for joining me, guys. I hope you found this at least a little bit informative. My name is John Campea, and until next time, my friends, bye-bye.